Hello, I'm Carmichael of PwC Global Accounting Consulting Services. The ISB finally published the standard on lease accounting early this year. IFRS 16 Leases introduces a new model of accounting for lease contracts that will have a huge effect, particularly for lessees. In this series of podcasts, we will discuss different aspects of the new standard and highlight some of the key areas of which we think you should be aware. Under the new standard, a lessee has to recognise a right-of-use asset and a lease liability for almost all lease contracts. A distinction between a finance lease and an operating lease is no longer made. In practice, this means that the only time there is no on-balance sheet accounting, and as a consequence a significant increase in debt, is when the lease contract does not meet the definition of a lease. Therefore, the definition of a lease and the interpretation of the different criteria will become extremely important. This podcast focuses on this definition. IFRS 16 states that a contract contains a lease if there is an identified asset and the contract conveys the right to control the use of the identified asset for a period of time in exchange for consideration. The standard contains a flowchart of how to perform the analysis as to whether the definition of a lease has been met. Now let's have a closer look at each of the steps. First of all, there needs to be an identified asset. What does this mean? An asset can be identified explicitly in the contract, for example by a serial number or a similar identification. But an asset can also be identified implicitly without being mentioned in the contract. This is the case if the supplier can fulfil the contract only by the use of a particular asset. In any case, there is no identified asset if the supplier has a substantive right to substitute the asset. Substitution rights are substantive where the supplier has the practical ability to substitute an alternative asset and would benefit economically from substituting the asset. If the customer cannot readily determine whether the supplier has a substantive substitution right, it is presumed that the right is not substantive. Now let's move on to the second step, the right to control the use of the identified asset. A contract conveys the right to control the use of an identified asset if the customer has both the right to obtain substantially all of the economic benefits from use and the right to direct the use of the identified asset throughout the period of use. When assessing whether the customer has the right to direct the use of the identified asset, the key question is which party, that is the customer or the supplier, has the right to direct how and for what purpose the identified asset is used throughout the period of use. The standard gives several examples of relevant decision-making rights. Right to change what type of output is produced, right to change when the output is produced, right to change where the output is produced, or right to change how much of the output is produced. It's important to note that protective rights are not taken into account. So if, for example, a customer who has hired a ship is prevented from sailing the ship into waters with a high risk of piracy or transporting hazardous materials, this does not prevent the customer from having the right to direct the use of an identified asset if all other criteria are met. In some scenarios, the decisions about how and for what purpose the underlying asset is used are already predetermined before the inception of the lease. If this is the case, the customer has the right to direct the use of an asset if it either has the right to operate the identified asset throughout the period of use without the supplier having the right to change those operating instructions, or has designed the identified asset or aspects of the asset in a way that predetermines how and for what purpose the asset will be used throughout the period of use. The analysis of whether a contract contains a lease can be very complex, so it's probably worth illustrating the principle with an example. In this example, a contract conveys the exclusive use of an explicitly specified aircraft. The customer determines where and when the aircraft will fly, and which passengers and cargo will be transported. The supplier is responsible for operating the aircraft. The supplier is permitted to substitute aircraft. However, the substitute aircraft must meet the original specifications in the contract. Outfitting an aircraft in the supplier's fleet to meet those specifications will result in significant costs. Now let's walk through the steps of the analysis. In the example, the leased asset is explicitly specified in the contract. The supplier has the right to substitute the aircraft. However, as the substitution will result in significant costs, it will not economically benefit from a substitution, and hence the substitution right is not substantive. The customer has the exclusive right to use the aircraft throughout the lease term and therefore obtains substantially all of the economic benefits from use. Finally, the customer has the right to direct the use of the aircraft throughout the period of lease, as it decides where and when the aircraft will fly and which passengers and cargo will be transported. The fact that the supplier operates the aircraft does not affect the decision, because the right to operate does not grant the right to direct the use of the asset. So as the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration, the definition of a lease is met. So that's the principle behind the definition of a lease, and an example of how it might be applied in practice. As you'll have seen, the assessment involves what might be some quite complex judgments. We expect this to be one of the more challenging aspects of implementing the new standard. Hopefully, this short video helps you prepare for that process. Thanks for listening. Our range of publications on IFRS 16 leases provides more information on the practical application of the new standard and is available in PwC Inform. If you have additional questions, please reach out to your local PwC contact.